The U.S. economy is in a period of significant flux, driven in part by ongoing political shifts, including President Trump's policies. From tariffs to tax reforms, economic changes have created a landscape rife with speculation and misinformation. This environment has fueled several financial myths that many individuals and businesses still believe today. As we navigate the 2025 Trump economy, it's essential to debunk these myths and get a clearer understanding of how economic policies actually affect financial decisions. In this video, we will bust the top 10 finance myths that have emerged during the current economic climate. 1. Myth: tariffs help domestic manufacturers without downsides. One common belief is that tariffs on imported goods, especially on foreign-made products like steel and automobiles, will solely benefit domestic manufacturers by making their products more competitive. While it's true that tariffs can reduce competition for U.S. manufacturers, the increased production costs often outweigh these benefits. U.S. manufacturers who rely on foreign-made components face higher costs, which can lead to price hikes and reduced profits. In turn, consumers bear the brunt of these higher prices. 2. Myth: tax cuts automatically lead to economic growth. Under the Trump administration, tax cuts were touted as a sure way to stimulate the economy by encouraging businesses to invest and hire more employees. While tax cuts may have short-term benefits for certain sectors, the long-term effects are less clear. Evidence suggests that tax cuts can increase deficits and public debt without a corresponding rise in job creation or economic growth. In fact, some businesses used their tax breaks to repurchase stock, rather than reinvesting in the workforce or infrastructure. 3. Myth: inflation is guaranteed to rise due to tariffs. Many people assume that tariffs will always lead to significant inflation, especially on everyday consumer goods. While it's true that tariffs can increase prices in some sectors, inflation is influenced by many factors, including consumer demand, wages, and supply chain efficiencies. In some cases, businesses may absorb the costs of tariffs rather than passing them on to consumers, which can prevent widespread inflation. Moreover, the Federal Reserve has tools at its disposal to control inflation even during periods of tariff uncertainty. 4. Myth: the stock market always reflects the health of the economy. The stock market is often seen as a barometer for the overall economy, with rising stock prices suggesting economic health and falling prices indicating a downturn. While stock performance can provide some insight into investor confidence, it does not always mirror the broader economy. For instance, during the 2025 Trump economy, the stock market may be buoyed by optimism surrounding certain sectors, like technology or defense, even as other parts of the economy may struggle with high tariffs or shifting trade relationships. 5. Myth: interest rates will continue to rise under Trump's policies. Many financial analysts predicted that interest rates would rise steadily under President Trump due to the administration's fiscal policies, such as increased government spending and tax cuts. However, the Federal Reserve's decisions on interest rates are more dependent on economic data, including inflation and unemployment, than political rhetoric. If inflation remains under control and economic growth slows, the Fed may reduce or maintain current interest rates, rather than continually raise them. 6. Myth: the U.S. dollar will always strengthen with economic nationalism. President Trump's focus on "America First" policies, including tariffs and trade barriers, led some to believe that the U.S. dollar would continue to appreciate as the U.S. economy became more self-reliant. However, this is not always the case. While a strong dollar benefits imports and U.S. travelers abroad, it can also hurt U.S. exporters, making their goods more expensive in foreign markets. Additionally, geopolitical instability and trade disputes could lead to a weaker dollar if investor confidence declines. 7. Myth: higher wages are a result of tariffs. Another popular belief is that tariffs will lead to higher wages for American workers, as companies will be forced to pay more to retain their workforce in a protected domestic market. In reality, tariffs are more likely to increase the cost of living, with little to no direct effect on wages. While some sectors may see wage increases due to protectionist measures, many industries facing higher input costs may be forced to cut back on hiring, freeze wages, or even lay off employees, resulting in little net gain for workers. 8. Myth: economic uncertainty always leads to a recession. Many Americans fear that economic uncertainty, such as the ongoing tariff wars and global trade tensions, will always lead to a recession. While uncertainty can slow economic growth and cause market volatility, it doesn't necessarily result in a recession. The U.S. economy is resilient, and factors such as strong consumer spending, innovation, and federal interventions can help prevent a full-blown recession, even during periods of heightened uncertainty. 9. Myth: rising corporate profits equate to increased investment in the workforce. A commonly held belief is that if businesses are making more money, they will reinvest those profits into creating more jobs, increasing wages, or improving employee benefits. However, companies may choose to use profits for stock buybacks, dividend increases, or executive compensation rather than reinvesting in their workforce. In many cases, even with rising profits, workers may not see the full benefit of the company's success. 10. Myth: more jobs mean a stronger economy for everyone. While more jobs typically signal a healthy economy, the quality of those jobs matters just as much. The rise of gig work, part-time positions, and jobs in lower-wage sectors does not always translate into long-term financial stability for American workers. The 2025 Trump economy, with its focus on trade policies and manufacturing, may create more jobs in certain industries, but the benefits could be uneven. Many jobs may not provide sufficient wages or benefits to lead to meaningful improvements in the overall standard of living for workers. The 2025 Trump economy has brought about substantial changes in the U.S. financial landscape. As policymakers continue to push forward with tariff-related strategies and economic reforms, it's crucial to separate fact from fiction when it comes to personal finances. Understanding the myths surrounding tariffs, taxes, stock markets, and wages will help consumers, businesses, and investors make more informed decisions. By busting these 10 common financial myths, Americans can better navigate the complexities of the current economic environment and plan for a more secure financial future.